If you bought SpaceX stock the moment it started trading, here is what actually happened to your money. In a single day, it could have surged 30%. Within 4 days, it could have peaked at a 67% gain. And less than 2 weeks later, that same investment could have been sitting at a loss. Same stock, same investor. 3 completely different outcomes, all within the first month of trading. This is the real story of the SpaceX IPO returns. Not the headlines, not the hype, but what actually happened to the people who put real money into the biggest public offering in stock market history. And the lessons hiding inside this single stock's wild first month apply to every single investor watching this video, whether you bought SpaceX or not. Welcome back. I am Warren. And on this channel, we break down what actually happens with your money, not just what the headlines promise. If you want the real story behind the numbers, hit that like button right now, subscribe, and let us get into exactly what happened. Let us start with the basic facts, because the scale of this IPO genuinely changes how we need to think about it. On June 12, 2026, SpaceX completed the largest initial public offering in the history of the stock market, pricing shares at $135 each and raising approximately $75 billion. The offering was so oversubscribed that underwriters exercised the full overallotment option, ultimately raising closer to $86 billion. At the IPO price, the company entered public markets with a valuation approaching $1.8 trillion, and the event made Elon Musk the world's first trillionaire. Day 1. The explosive debut. Trading opened at $150 per share, already $15 above the IPO price. From there, things moved fast. At one point during the first day, shares surged more than 30%, briefly pushing SpaceX's market valuation above $2.25 trillion, putting it ahead of companies like Microsoft and Amazon for a moment in trading history. By the closing bell, the stock settled at $160.95, a gain of 19% from its opening price and roughly 19% above the IPO price as well. For an investor who managed to get shares at the $135 IPO price, which was largely reserved for institutional investors and a portion of retail investors through specific brokerage allocations, day 1 alone represented a paper gain of approximately 19%. For context, that is a gain that would take a typical diversified stock portfolio 1 to 2 years to achieve on average. SpaceX delivered it in a single trading session. Trading volume told its own story. Roughly 500 million shares changed hands on debut day, approaching the trading volume Facebook saw during its own historic 2012 IPO debut. This was not quiet institutional trading. This was a genuine retail and institutional buying frenzy, fueled by Musk's celebrity, the company's mission, and what analysts described as broad AI-fueled market euphoria. Day 2. The momentum continues. The excitement did not stop with the opening bell. On the first full day of regular trading following the debut, SpaceX shares climbed an additional 20%, with roughly 244 million shares trading hands. Investors who held from the IPO price were now sitting on gains well above 40% in just 2 trading days. Investors who bought at the closing price on day 1 were enjoying a substantial bonus gain on top of an already remarkable debut. This is the part of the story that captures headlines and fuels excitement. And it is also the part of the story that creates a dangerous illusion for investors watching from the sidelines, because the next part of the story almost never makes it into the highlight reel. The peak, and what came next. SpaceX stock continued climbing in the days following its debut, eventually reaching an intraday peak of $225.64 on June 16th, just 4 trading days after the IPO. At that peak, an investor who bought at the $135 IPO price was sitting on a gain of approximately 67% in 4 trading days. That is the kind of return that, under normal market conditions, might take a well-performing stock several years to deliver. And here is where the story most financial content conveniently leaves out begins. From that peak, the stock fell for 3 consecutive trading sessions. By late June, SpaceX was trading around $153, still comfortably above the $135 IPO price, representing roughly a 13% gain for IPO price investors, but a significant retreat of approximately 32% from the intraday peak just days earlier. Then, amid a broader $600 billion technology sector sell-off in late June, SpaceX shares briefly dropped below their IPO debut levels entirely, meaning investors who bought during the initial excitement at prices above the original $135 offering found themselves underwater on their investment within roughly 2 weeks of the stock's historic debut. The numbers that explain the volatility. Why has SpaceX stock moved so violently in its first month of trading? The data gives us several clear answers. First, the valuation itself is extraordinarily aggressive relative to the company's actual financial performance. SpaceX reported revenue of approximately $18.7 billion in 2025, but also posted a GAAP net loss of nearly $5 billion for the same year, at a market capitalization that has fluctuated between approximately $1.8 and $2.2 trillion. The stock has been trading at roughly 95 times its 2025 revenue. For context, that is a valuation multiple reserved almost exclusively for early-stage, high-growth technology companies, not companies posting billion-dollar annual losses. Second, the float is unusually small relative to the company's total value. Musk retains control of roughly 42% of total equity and approximately 85% of voting power, meaning a relatively small portion of SpaceX's shares are actually available for public trading compared to its nearly $2 trillion valuation. When a stock has a small float relative to its size, even moderate buying or selling pressure can produce dramatically amplified price swings in both directions, which is exactly what we have seen play out. Third, professional analyst opinion on the stock has been sharply divided from day one. CFRA Research initiated coverage with a sell rating and a 12-month price target of just $115, nearly 29% below the closing price on day one, citing the company's extremely ambitious growth strategy and elevated valuation expectations. Morningstar valued the stock even lower, at $63 per share, describing it as significantly overvalued. Meanwhile, other firms like New Street Research have initiated bullish coverage with price targets above the current trading range, arguing that SpaceX needs to be evaluated over a 20 to 25-year time horizon rather than typical quarterly metrics. When professional analysts disagree this dramatically about fair value, that disagreement itself becomes a source of ongoing volatility as the market searches for consensus. What the historical data says about mega-IPOs. Here is a piece of context that deserves real attention because it applies far beyond just SpaceX. A Reuters analysis of the 50 most valued IPOs over the last 5 years found that investors would have been better off simply buying an S&P 500 index fund roughly 3/4 of the time, compared to buying into a large, hyped initial public offering. 3 out of 4 times. That statistic alone should reshape how any investor approaches a headline-grabbing IPO, regardless of how exciting the company or the technology behind it might be. The pattern is remarkably consistent across decades of market history. A high-profile debut generates intense initial demand and a price surge, followed by a cooling-off period as the market recalibrates the stock to its actual fundamentals, rather than its initial hype-driven valuation. Facebook's 2012 IPO followed this exact pattern. So did numerous other major debuts. SpaceX's first month of trading, explosive gains followed by a sharp pullback, fits this historical pattern almost precisely. What this means for different types of investors. Let us break down what these returns actually mean depending on when an investor entered the stock. For investors who received shares at the $135 IPO price, primarily institutional investors and the roughly 30% of the offering allocated to retail investors through participating brokerages. Even with the late June pullback, the position remained profitable, sitting at approximately a 13% gain as of late June. Volatile, but net positive. For investors who bought during the excitement of day 1 or day 2 at prices well above the original IPO price, chasing the momentum rather than securing the original allocation, the math looks considerably less favorable. An investor who bought near the intraday peak of $225.64 was, by late June, sitting on a paper loss of roughly 32%. This is the textbook definition of FOMO-driven investing, and the SpaceX IPO has already produced a real-world case study of exactly how expensive that behavior can become in a matter of days. The broader lesson beyond SpaceX specifically. Even if you never bought a single share of SpaceX, this story matters for your own investing behavior. It is a live, real-time demonstration of several principles that apply to every high-profile IPO that will ever come to market. Extreme initial volatility is the rule for major IPOs, not the exception. The excitement and media attention surrounding a debut like this create buying pressure that frequently pushes prices well beyond what underlying fundamentals support in the short term. And that excess gets corrected, often quickly and painfully for anyone who bought during the peak of the hype cycle. Valuation still matters, even for genuinely exceptional companies. SpaceX's technology, its market position, and its long-term vision are not in serious dispute among analysts. What is in dispute is whether a valuation of 95 times revenue for a company currently posting billion-dollar losses is justified by that vision. Being right about a company's long-term prospects and being right about the price you pay for it are two entirely different skills, and conflating them is one of the most expensive mistakes an investor can make. And finally, time horizon changes everything about how a single month of returns should be interpreted. An investor with a 20-year horizon who bought at the IPO price and intends to hold through volatility is in a fundamentally different position than a trader who bought at the peak expecting quick momentum gains. The same stock, the same price action, produces completely different outcomes depending on the strategy and patience of the investor holding it. Here is the SpaceX IPO story in its simplest form. A historic debut, a 19% first-day gain, a 67% peak within 4 trading days, and then a sharp pullback that erased much of those gains and, for some who bought near the top, turned a winning position into a loss, all within the first month of trading. This is not a story about whether SpaceX is a good company. By almost every measure, it is an extraordinary one. This is a story about the difference between a great company and a great investment, and about how quickly the gap between hype and fundamentals can reassert itself, even for the most exciting stock market debut in history. Whatever you decide to do with SpaceX going forward, let this first month be a real current example of why discipline, time horizon, and valuation awareness matter more than excitement, every single time. Drop a comment below and tell me whether you bought into the SpaceX IPO and how it has gone for you so far. I read every single one. And if this video gave you a clearer picture of what actually happened, hit that like button, subscribe, and share this with someone who got caught up in the SpaceX excitement without seeing the full picture. I am Warren, and I will see you in the next one.